The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The gold rally stalled out on Tuesday. This Wednesday, the stock market momentum fades as well. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And as Romaine said, it doesn't look too good right now. The S&P 500 down about 0.7%. You can see a lot of that pain, a lot of that selling is concentrated in your tech names, with the NASDAQ 100 off by about 1.3%. At the moment right now. We have a big slate of earnings after the bell. Maybe that will turn things around, but at least for right now, that bond market rally continuing to a quiet pace right now. The 10-year yield down another basis point or so, sitting at 395. And I did want to highlight gold once again. It's not exactly the move that we saw yesterday, but gold down another 1%, Romaine. We are above 4,000 still, but just so.
Yeah, a real loss of momentum in that precious metals trade. And I do want to talk a little bit more about momentum, at least on a long-only basis in the equity market that had been the best performing factor year to date heading into this month. Last week, though, it was the worst performer. And today, by far, the worst once again. Technical indicators had been signaling that the rally was overstretched, and news just this afternoon that the U.S. may impose new software-related restrictions on exports to China, that intensified the market pullback. Now, some of the declines today are indeed head-turning. You take a look at Netflix having its worst post-earnings slide since 2022. GE Vernova losing ground for a seventh straight session. Texas Instruments flirting with oversold conditions. But to Thomas Lee over at Fundstrat, the post-earnings slide is not thesis changing. In his words, he still sees a strong showing for stocks over the final 10 weeks of the year, supported by corporate earnings.
The earnings beat rate, not just in tech, but in the broader market, the earnings beat rate will be even better than in the second quarter, and that would then be the biggest earnings beat rate since COVID.
Max Kettner there channeling a bit of Tom Lee, and he's got a point, because despite last night's disappointment from Netflix, about 85% of the S&P companies reporting earnings so far have beaten on profits. Of course, right now on course, I should say, for their best performance since 2021. And as we venture deeper into the season, keep in mind the peak of that buyback blackout window, that's actually going to move behind us, which does set up the potential for a corporate bid coming back into equity markets sometime soon, Katie.
Well, I want to return to that stat that you just said, that you take a look at the performance so far from S&P 500 companies on the earnings stage, and it's pretty good. 85%, as Romaine said, have beaten profit expectations. That is the best performance in about 4 years. It's early yet. We know that. There's some big names to get through, including the names after the bell this evening, including Tesla. But you take a look at where that stands relative to recent history. That bar is the highest in 4 years. You can see it's always pretty good when it comes to the percentage that's beating overall, but especially in the past couple of quarters, it has been a gentle slope higher, Romaine, and we'll have to see, of course, whether that trend continues or if some of the big names that we will get through bring us back down.
All right, let's kick things off with an old friend of the show, Sherry Paul, Managing Director of Private Wealth Advisor and Senior Portfolio Management Director at Morgan Stanley Private Wealth Management. I'm going to get your titles right sometime. Great to see you once again here. Let's start with earnings. I mean, I know it's still relatively early in the earnings season, but I think the last couple times we've spoken, we've talked about some of the upside surprises that we've seen in earnings. And I'm curious if you expect, that to continue, not just for the current reporting period, but for the next one as well.
Yeah, no, it's a great question. I think the next leg of the bull market will be a broadening out of the broader market participating. I mean, this past year we've had 7 to 10 companies make up a big portion last year of this market return. This year now, the other 490 are representing maybe 70% of the return year to date. And, don't fight the earnings. Mm-hmm.
Don't fight the earnings. I am curious just about the overall mood in markets right now. On the surface, I mean, given the record highs that we've had as of late, it does appear most people, if not bullish, certainly have just accepted the fact that this is what it is and you're just going to ride that tape. But is there any concern that you have that there is a big risk out there that could sort of trip up this rally?
Yeah, I think that the big risk is if people forget that there are two things that always happen in markets. Number one, they always reset at some point. Mm-hmm. And then they always recover. The variables are causality, what caused the reset, so typically to a recession or some kind of unexpected traumatic event, which we've had, throughout the last 20 years. And then we go into recovery. And this year we've had, I think, 31 new highs in the market, which is tough for people. And the underpinning of that, I think, is even more complex for people to grasp because it's not just a traditional earnings market. We've got this, this innovation premium that's injected into the market along with some pretty powerful legislation that's coming online in January, along with deglobalization, and all of that is accelerating the earnings cycle in a different way.
It's a good point because, I mean, the market is a forward-looking animal. It's particularly in this moment, it feels very forward-looking to the next decade or so, how AI is going to change things. But when you mentioned the 31 record highs that we've seen so far this year and how that's difficult for people to grasp, an explanation that I heard for why you're seeing so much money go into gold, maybe not the last 2 days, but also go into money market funds is because it's fear on both sides. You need to participate in the market, but people are also a little bit uncomfortable with just how far we've come.
Yeah, I think that makes a lot of sense, Katie. And there are two sort of constituencies in the market. People who rode this wave and made money in the last 3 years, and then people who completely missed it. And both of those constituencies have a lot of cash to deploy. So once we start to see these sell-offs, it's not uncommon that we see people step in and say, wow, I missed it. Now I can kind of step in and start to pick up positions, which is what we're recommending. It's never the wrong time to start doing the right thing if you've been sitting in cash and you're about to take a guaranteed pay cut.
Well, let's pretend for a moment that you were sitting in cash. You were over allocated for the past couple of years. You see the run up that we've seen in stocks and you have some money you would like to put to work. I mean, where in this market is an opportunity to do that still?
Well, look, I think that it's always an opportunity to start with the basics of building a diversified portfolio. The problem with that right now is that the small, mids, large, and European markets are 98% correlated. So what we're doing with new clients is we're diversifying across idea sets and across thematics, and then we're sifting through those thematics to see which ones transcend political and policy volatility that are enduring regardless of what happens at the global stage, and then picking the best players, which will typically you'll find in the large cap space that have the strongest balance sheets that can lean into that. And that puts you back into tech, industrials, materials, and a lot of the shadow sectors that didn't really participate, there's still a lot of opportunity there.
I do want to go back to this idea of kind of what she was hitting with the long term, what you're hitting on with innovation. I just had to kind of go at the Bloomberg terminal because you've been on this show a few times in the past where you kind of talked about the innovation in the economy and how that feeds into the market. I thought that was last year. You did bring it up last year, but you brought that all the way back up in 2023, which, I mean, not to, just laud you completely here, but that was a bit prescient at the time because there are a lot of people were sort of looking at the spend that we were starting to see ratcheting up in technology and wondering why would it pay off. Now, here we are a couple of years later, and it does appear, at least for a large cohort of companies, we are seeing, or at least we have the potential for a big payoff. You still believe that?
Well, yeah, because, and I appreciate you bringing that up, because what I saw, was in 2021 or 2021-22 time period when my team and I started investing in the ecosystem of AI, both at the infrastructure cloud level. We're now in the installation mode, which we talked about in 2023, where the accelerant here is productivity enhancement, replacing expensive human labor. And these are being installed in companies that we know already make money. So instead of having to take speculative bets and get a 30% return, you can do that in big cap companies right now. And the accelerant, I think, probably is for another 2 years. I always felt like this was a 5-year J-curve explosion, and that's why we had those high Ps on the front end that people were like, oh my God, this is like 1998 again, 1999. But the thesis was that we would see such an accelerated expansion of earnings that the Ps would come down, and then we would get the appreciation, plus locking in some dividends for clients along the way, expecting that the Fed would cut rates. And so that's sort of the setup that we're in right now. To your point about forward thinking, though, we're already looking out to what does next June look like? That's really what investors who are in cash should be thinking about. And that can put you in like a dollar cost averaging. But we're kind of past this earnings already in my mindset and looking into June.
Always a long-term thinker, which I guess is fitting given what you do for a living. Sherry, always great insights. Sherry Paul is a managing director, private wealth advisor over at Morgan Stanley Private Wealth Management, kicking us off to the close here on this Wednesday afternoon. When we come back, we're going to talk about the Fed decision, a decision that is 1 week away from today. And we're going to do that with former New York Fed President Bill Dudley, who has some thoughts about whether financial conditions are indeed tight. That's coming up next here on The Close. This is Bloomberg.
Well, we are a week away from the next Fed decision with the government shutdown now the second longest on record. At least one more rate cut is widely expected from the central bank, with Fed Chair Jerome Powell citing pressure on the labor market in recent remarks. Former New York Fed President Bill Dudley writes in a Bloomberg op-ed today that the Fed may be more dovish than Powell thinks. And I'm pleased to say he joins us now. Bill, great to have you with us. A line in your column sticks out to me, and that is that, to my mind, financial conditions have eased too far, beyond what's consistent with the Fed's objectives and beyond what expectations of further rate cuts alone should merit. So if that's the case, Bill, I mean, how do you think that that should inform Fed policy going forward, especially as it pertains to cuts?
Well, I think they should be cautious. And obviously, they're going to cut rates next week. Nothing's really changed. They don't have any new information to contradict the path that they're on. So they're definitely going to cut rates at next week's meeting. The point I was trying to make in the article is very simple. The Fed is basically saying monetary policy is modestly restrictive. We need to make it less restrictive because the downside risks to the labor market are increasing. But if you assess monetary policy not by the level of the short-term interest rates, but by financial conditions, monetary policy doesn't seem to be restrictive at all. Financial conditions right now are actually quite accommodative. The Federal Reserve Board staff has developed a financial conditions index. And at the end of August, which is the most recent reading from their model, they thought that financial conditions at the current setting was going to boost real GDP growth by almost a percentage point. That's easy financial conditions. That's not a restrictive monetary policy. So I think the Fed should be putting a little bit more weight on the fact that the stock market's been very strong, bond yields have fallen, the dollar has weakened, credit spreads are narrow. All those things are supporting economic activity,
Right.
and put a little bit less weight on the level of the federal funds rate.
Right. I hear what you're saying, especially when you think about all the different measures that do make up financial conditions. But, I mean, you take a look at some of the potential warning signs here, especially what you're seeing in terms of the credit space right now. We know that Tricolor Holdings basically filed for bankruptcy. Then today, this morning, you had Primalend also file for bankruptcy. So you add it together, you are starting to see some stress among lower income Americans, basically falling behind on car loans and the like. There is that concern about the labor market as well, Bill. I mean, are those things that can be helped by lowering interest rates?
I mean, it help a little bit. I mean, obviously, if you lower interest rates and bring down bond yields, that's going to support the U.S. housing market, make housing more affordable. But you're right, monetary policy is a very blunt instrument, and right now it's a tale of two economies. If you're a high-income household that has good exposure to the equity market, you locked in your mortgage back during the COVID pandemic, you're feeling pretty good about things. If you're a low moderate income household, don't have a lot of savings, don't have financial asset exposure, job hiring is tapered off a lot. You're not doing very well. But the Fed basically has to take the entire economy into consideration in terms of setting monetary policy. Monetary policy is not very good. It's sort of oriented towards one, income sector of the population. I think the message right now is financial conditions are extremely accommodative, basically as accommodative as they've been over the last few years. And I think the Fed just needs to put a little weight on that, especially in an environment where inflation is continuing to run above their 2% objective. Next year, we're going to have inflation above 2% again. That'll be the fifth year in a row that inflation's above the Fed's 2% objective. So, yes, there are some downside risks to the labor market, but there's also some upside risks in terms of inflation expectations becoming less well anchored.
I mean, what exactly could the Fed do, Jake Powell do, to sort of, I guess, re-anchor, for lack of a better phrase, those inflation expectations? Is it just about what he says, or is there something more tangible that they can do?
Well, right now, the market has a lot of easing priced in over the next year. If you look at the federal funds futures market, by the end of 2026, they have the federal funds rate below 3%. What the Fed could do is say, look, we don't think we're going to actually have to cut rates that much more because financial conditions are so accommodative. And if you did that, then you take out some of that easing that's priced into the market. Bond yields would firm a little bit. The stock market would react to that, and financial conditions would be less tight. Would be less easy. So the Fed could sort of slow things down a little bit in terms of how much stimulus financial conditions are providing by making it clear that we're not going to cut rates as far as the market thinks.
I am curious, though, Bill, when we start to talk about this idea, and we talk a lot on this show, I should say, about AI and the potential for enhancements to U.S. productivity across industries as well. Is it too early for the Fed to try to take that into account as well?
Well, right now, it's probably actually pushing up the equilibrium level of interest rates because it's leading to this huge investment boom that's sort of independent of the business cycle. So right now, you're seeing a lot of additional investment that you wouldn't normally be seeing at this stage of the business cycle. Now, eventually, that AI investment spending is going to lead to significant increases in productivity growth, but those are probably later as opposed to right now.
And Bill, just quickly, we don't have a lot of time left, but we should talk a little bit about the government shutdown and basically the fog that the Fed is having to make monetary policy. And we are going to get that delayed CPI release on Friday, but even still, we haven't gotten official updates on the labor market, on some of these other measures that we know are important. And with that in mind, I mean, I would love your perspective on how basically you can proceed and make monetary policy with this type of uncertainty.
Well, the cloudier it is, the more cautious you want to be. So you want to basically slow down to avoid making a policy mistake. So lack of government information makes it very hard for the Fed to be confident about their economic forecast because they're not seeing anything that either confirms or contradicts it. So I think this is another reason why after they cut rates next week, maybe they need to go on to a pause to see which way is the economy really heading. You look at the Atlanta Fed GDP Now forecast for the third quarter, that's tracking 3.8%. That's not a slow economy.
Bill, always a pleasure to talk to you. Former New York Fed President Bill Dudley, now a Bloomberg opinion columnist here, a breakdown here of the choices that the Fed faces as it heads into its next policy meeting next week. When we come back, we're going to focus in on Tesla. The company expected to report earnings after the bell tonight. Some big questions, not so much on the quarter that just passed, but on the years ahead and what this company can transform. When we come back, a conversation with the Vice President of Market Research over at Telemetry. This is The Close on Bloomberg. All right, we're less than a half hour away, I should say, from Tesla's earnings. The EV maker expected to post a 25% decline in its profits from the most recent quarter from a year ago, according to data compiled by Bloomberg. But the shares, of course, have been impervious to some of that slowdown in EVs as the market looks a little bit further out to some of those autonomous vehicles and robots that the company has been promising. Sam Abuelsamid joins us right now, Vice President of Market Research over at Telemetry, a transportation and mobility research and advisory practice. All right, Sam, I mean, I never really know how to even think of Tesla anymore. I know if you talk to Elon Musk, he'll tell you, we're a tech company, we're an AI company, we're this and that. When you take a look at it, and you look at, obviously, the car business that they are still dependent on for cash, but also this future of autonomy and robotics, where do you see it going?
Well, clearly the car business, which is the vast majority of their revenue, it's about 85% of their revenue, is not growing. It hasn't grown for quite a few years. We did see an uptick in their sales in Q3, but that was almost entirely due to some pull ahead of EV buying ahead of the federal tax credits going away at the end of the quarter. Every other market, pretty much outside of the United States, Tesla sales were down. They were down significantly in most European countries. They were down in China for the third quarter. So their car business is very challenged right now. All of the other things like AI, robotics, autonomous vehicles, robo-taxis, all of that stuff is still largely fantasy at the moment. Most of Tesla's valuation for the last several years has been based almost entirely on this promise of generating huge new revenues from robo-taxi services. But the reality is, from what we've seen, that's just not likely to happen anytime soon. The system that they have is not likely to be able to be used on a wide scale as a robo-taxi for the foreseeable future. And humanoid robotics is probably not going to be at any significant scale for a long time to come as well.
Sam, and with that in mind, I mean, you talk about the valuation that the stock has and just the run that it's seen over the past couple of years. A lot of that has to do with the future and hopes about robotics, but a lot of that has to do with the Elon Musk premium and what he commands as sort of the head of the company who is going to be steering Tesla theoretically to that future that includes robotics so heavily. And that's sort of the underpinning of this pay package that we've been talking about. And, as we head into earnings, I wonder, where you fall on that question that Elon Musk does command a big premium here.
Yeah, I mean, it's always been about the narrative, the story that he tells to the public and to investors. And as long as people are willing to believe that story, no matter how fantastical it might be, they seem to be willing to keep pricing up the stock. I look at it more from a technical perspective. Is any of what he's promising actually likely to come to fruition? And from what I see, I don't see it. I don't see that happening.
I am curious, Sam, overall, when we talk about what's been happening in this space, do you see other players there that maybe can get there in a way that Tesla might not be able to?
Certainly, on the autonomous vehicle side, yeah, absolutely. Waymo is far and away the leader in that space. They have technology that actually works. They are operating unsupervised commercial robotaxi services in 5 cities now. And by the end of 2026, that will probably be closer to 20 than to 10. They're expanding into London next year. They're expanding into Japan, a number of new American cities. There are others as well, like Zoox. Motional is expected to start their robotaxi service next year. So there are lots of companies. And in China, there's a number of players in China, including Baidu, WeRide, Momenta, and others that are having some significant success. On the robotics side, again, there's lots of players in that space that are building robots. Boston Dynamics has been doing it for a long time. But the reality of seeing those widely deployed, certainly in manufacturing, is probably pretty limited. I was just at a GM event this morning where they were talking about their new autonomous robotics lab.
Right.
And, their focus is on these collaborative robots, and the idea, for robots don't need to have legs. They need to have the manual dexterity to pick things up.
Yeah. Right.
That's great. And you can do that. But actually, they work better with wheels than they do with legs. There was a great comment from Sterling Anderson, the new chief product officer at GM, that if humans could have evolved wheels instead of legs, we probably would have. It probably would have been more useful to us.
All right, Sam, got to leave it there. That is Sam Abuelsamid. He is VP of Market Research.
That gives us a lot to think about here.
Yeah, really.
If we had wheels
if I had chosen to evolve, perhaps it would have been with wheels. In any case, you're watching The Close on Bloomberg.
Just want to bring you some breaking news here. Seeing oil prices start to drift higher after settlement. This on comments by the Treasury Secretary of the United States, Scott Bessent, saying that the U.S. will announce a, quote, pickup in Russia sanctions either today or tomorrow. And to put a finer point on it, Bessent says it will be a substantial pickup. We should also point out just prior to that, there was another headline that crossed the terminal saying that the U.S. will allow Ukraine to use some long-range missiles, and that would be a shift in U.S. policy with regards to its stance in the Russia-Ukraine war. Katie?
Take a look at the markets right now. Not too much reaction specifically to that headline. The S&P 500 lower on the day to the tune of about 0.6%. We know that big tech certainly in the hurt locker with Netflix down about 10%, but there are some bright spots, Romaine. Yeah,
one of the big bright spots out there. You're actually going to find that with Stifel today. Those shares actually rallying about 4 to 5% right now after the firm reported adjusted net revenue that beat estimates in the most recent quarter. This is also a company that saw a big pickup in activity in trading and in capital markets. And our next guest says Stifel is well positioned to build on that success. He would know. Ron Kruszewski is the chairman and CEO at Stifel, and he's also the chair-elect over at Sifma. Great to have you, Ron. If anybody knows your business, I would assume it would be you.
I hope so.
Let's talk about the rebound here. I mean, and we've seen quite a few of the financial firms have a pretty good quarter. We've seen, obviously, a lot of trading activity and volatility, but also I want to start off with just kind of the pickup that we've seen in M&A, deals activity, basically all that capital markets activity that seemed to be on ice earlier this year.
Well, look, at the beginning of the year, everyone thought this was going to happen, yet tariffs and tax policy were uncertain. Mm-hmm. And so people were sitting on their hands. I would be in boardrooms and talking to directors and that, and even M&A policy in terms of whether it would be more accommodative. That was all uncertain. Mm-hmm. Get the big, beautiful bill, I guess, passed. You get tariffs behind us, although they seem to come up every day.
Yeah.
But as you got that behind us, there was a lot of backlog that's now coming through. And it's not just today. It started in the summer. We had one of the busiest Augusts, in fact, the most busy August we've ever had in our history. So business is good.
Business is good. I am curious, too. Coming into this year, there was a lot of optimism on Wall Street about the change in Washington and the idea that, if not deregulatory environment, certainly a looser regulatory environment than what we saw the previous 4 years. Have you seen that already? Are you, I guess, pleased, or have you? What's happening there? Does it meet your expectations so far?
Yeah, I would say accommodative. Okay, versus, look, there's no secret that under the Biden administration, one of his first acts was to put out a memo that said, hey, I'll paraphrase, let's put sand in the gears of M&A. Mm-hmm. And the Trump administration is doing just the opposite. We see it especially, we've been very successful in depository M&A, which having the biggest year ever, unbelievable market share. I could go on and on, I won't. But what some deals that used to take 2 years to get approved, bank mergers, think about that, 2 years are getting done in 4 months. And when you think about sitting in a boardroom and you're thinking about doing a strategic combination, whether you're on the buy side or on the sell side, and waiting 2 years to know that's a major risk factor that's been taken off the table. So that helps. Mm-hmm.
And I do want to talk specifically about the wealth unit here, because I know that you have a long-term client goal of about $1 trillion in AUM. Would you look to a potential merger, a potential combination there to actually reach that goal?
Well, that's been my DNA. I've been CEO 28 years. We've done 40 transactions. I can go back and name them. We've, when deals have presented themselves with the right financial metrics, we have participated. We built Stifel both organically and through M&A, so of course we would. What I would say today, though, is that all assets, homes, financial assets, gold, everything is pretty rich in a valuation perspective. So we're not rushing. We're not going to do growth just for growth's sake. We think about shareholder returns.
Well, gold is getting less expensive by the day, but I hear your broader point there when it comes to valuations. Staying on the wealth unit, I did want to talk a little bit about advisor recruiting. You spent some time on the call talking about that. You had a strong first half of the year in terms of new additions. In the third quarter, I believe you added 33 new advisors. So give us a little bit more color on what the advisor recruiting landscape actually looks like right now and where you're actually recruiting from.
Well, we're recruiting from all over. We can recruit from the major firms, and we bring in people that we're an industry that want to have a second career. So we're across the board. And recruiting, again, it's not new for us. When I started, we had less than 200 advisors, and we have 2,500 plus, and that's just what we do. The recruiting environment's been strong. I mean, as a self-plug a little bit, I get to talk my own book. We were voted #1 by J.D. Power for advisor satisfactions. Advisors that are voting independently. That's been huge because it's true. And when you see that, you mix it with our culture, we're a great destination for advisors, and it's coming through in the numbers.
Right. And I want to talk a little bit about who these financial advisors are advising. We were talking about the rise of the self-directed investor with Ken Benston of Sifma yesterday. And there is this idea out there that you have more investors just going it out alone, basically being self-directed and making their trades and their investments themselves. And I wonder, if that's an existential worry for you, or are you hoping that those folks will sort of graduate up into using financial advisors?
Well, I don't know what Ken said, but let me put a little different thought on that, okay? Since I've been in the business, younger investors or new investors will start self-directed. They just start with smaller accounts, they're younger, and they'll be self-directed. And then as you start to have a family and have kids and not have time to do self-directed, you will look for advice. That has not changed. What has changed is the number of new investors. And we can thank the fintechs for bringing young investors into the game earlier. So when I look at it, the ability to have even more clients that understand investing is great. Although I did write an op-ed that talked about my worry, and that is that we're blurring for young investors. They really do not understand, in my opinion, the difference between compounding, which is investing, and consumption. If you can't build wealth unless you compound. Gambling is consumption, and we are mixing and blurring the lines between investing and like prediction markets and zero-day options. That's gambling.
But what do you think? I mean, with regards to well, I know what you think about prediction markets, but do you think that prediction markets will become a much bigger portion of our financial markets, or is this just some sort of fleeting fad that we'll forget about in a few years?
Well, I mean, I'll just say, wait a minute. You mean whether I can bet whether the coin flip is head or tails?
The binary,
That's not, that's not investing. That's gambling, all right? And the gambling markets are expanding. There's easy, you can get them on your app. It's easy, it feels like social media. But do not, that was my op-ed. Let's not confuse gambling with investing. So do I think prediction markets are going to be, parlay bets are getting bigger, everything's getting bigger.
But do you feel the pressure, I mean, from a business perspective, do you feel the pressure to maybe include prediction markets under the Stifel umbrella? Because, I mean, there were a lot of people a few years ago that said we would never entertain the idea of hosting crypto on our platforms, and of course now most people do.
But crypto is an asset class. Okay, we can argue whether or not there. But the way I differentiate, if you can invest in an asset where everyone can win, meaning the value goes up and everyone wins, then we'll have that on our platform. If it's going to be a completely binary bet, which is gambling, red or black, on the roulette table, heads or tails. I get asked all the time, why don't we put that on our platform? Well, that's because that's not what we do. And I feel there's reputational risk to have clients easily go from buying a stock to wagering. And so, yeah, I feel the pressure, but in my mind, it's not what we do and it's not what we're going to do.
We only have about 30 seconds left, but I do just want to, Ron, get your just overall thoughts on the state of our economy, the state of our nation, and kind of where you see it go. Are you relatively hopeful?
I am. Like every American, I feel that we're very polarized politically, and I think that I'm hoping that the younger generation will make my generation look back and realize that we didn't need to be so polarized. But as a country, we are the greatest country in the world with the greatest economy in the world with the greatest capital markets. So am I bullish on America? Yes, I am, always and will be. And if I'm not, I'm not sure we'll be sitting here talking.
Ron, a pleasure to have you here. Ron Kruszewski there, Chairman and CEO over at Stifel. We'll be back in a moment. This is Bloomberg.
Krispy Kreme shares are soaring right now, swept up in a surge of meme stock mania. It's the same excitement that's fueling Beyond Meat's multiplication in market value this week. Boy, that's a difficult word. Joining us now is Bloomberg's Norah Mulinda. Norah, I'm having deja vu because this is what we were talking about yesterday, Beyond Meat and Krispy Kreme, and here we are again.
Here we are. It feels a bit like whiplash, and that's exactly what we're seeing in terms of shares of Beyond Meat today. I mean, they were soaring as much as 112%, but we really are seeing that trade evaporating here. We are seeing shares pointing lower now, and that really just underscores the fact that you can't spend too much time on meme stocks. That's at least what a lot of Wall Street seems to think here in terms of the speculation about why the move could potentially be fading.
I know this is probably a question you can't answer, but I mean, who actually is driving this? Because I know we always say, oh, it's the retail traders, but I think we learned, particularly after the whole GameStop episode, that, yeah, sure, retail traders may have sparked it, but we saw a lot of institutions exploiting that volatility. And I do wonder if there's any evidence that they are maybe also behind some of the moves we've seen in Beyond Meat or Krispy Kreme and some of the others.
And that's the question that still remains for a lot of people today as we think about these two companies in particular. I mean, you do see a lot of retail traders in this specifically here. If you look at the short interest that we did see on the stock, we saw about 64% sold short, largely by institutions here through the end of September. And so the question here about the trade that we're seeing and the fact that it is evaporating here, the gains, is maybe it was potentially day traders trying to squeeze short sellers. And so that's what people are essentially speculating could be going on here, but no real indication here as to whether or not institutions are involved in driving this stock up.
I always wonder about the CEOs of some of these companies. Like, how is the C-suite viewing this, and how do you potentially act upon this? You have this moment in time.
Sell
your
bonds.
stock is
Sell
absolutely, yeah, exactly. Or do you issue shares? I don't know.
It's good publicity, right?
Yeah, but I don't know.
I just want to point out, too, I mean, I'm just looking at the Bloomberg terminal on DNUT. So, I mean, obviously we're talking about no profits, declining revenue, growth over the last few years here. So it just kind of makes you wonder sort of what people are buying into. I mean, the donuts are good.
I mean, clearly,
did you know they had donuts upstairs? They weren't Krispy Kremes.
Oh, I did have
They were like cronuts. But I guess
really
legally
good.
they couldn't call them cronuts or something.
Maybe there's a patent.
But they were basically a cronut knockoff.
Yeah, they had
there was
layers.
a lot going on in that the name of that donut.
Yeah.
But I guess people don't like their donuts hot and ready. That's what Krispy Kreme is known for.
They don't like their donuts hot and ready? They want them cold and hard?
Based on what we're seeing in terms of the numbers, the metrics here for the company.
Neither crispy nor creamy. Bloomberg's Norah Mulinda with the latest on the meme stock craze. And
you know, when I was a kid, my aunt, she used to make donuts at home.
Oh.
Yeah, they were very good.
That sounds like quite a setup because you have to fry them.
Yeah, I know, it was quite the setup.
Yeah, I don't cook. Coming up, we'll take you to the closing bell with Savita Subramanian. She is head of U.S. equity and quantitative strategy over at Bank of America. This is The Close on Bloomberg.
The next leg of the bull market will be a broadening out of the broader market participating. I mean, this past year we've had 7 to 10 companies make up a big portion last year of this market return. This year now the other 490 are representing maybe 70% of the return year to date. And, don't fight the earnings.
And that was Sherry Paul over at Morgan Stanley Wealth Management kicking us off to the close here on this Wednesday afternoon as we await some big earnings after the bell tonight out of Tesla. The markets, though, decidedly in the red on the day.
Yeah, we'll see, of course, if Tesla, if IBM can change the narrative here, because right now decidedly lower on the S&P 500, off our worst levels of the session, but still solidly lower. The NASDAQ 100, your big tech names leading those losses. Netflix having a pretty sour reaction to the earnings that they delivered last night. That is weighing on both of those indexes. Then you take a look at the bond market, pretty much unchanged when it comes to the long end, as measured by the 10-year Treasury yield, flat on the day. And gold continuing to fall, though down not as much as we were just about an hour ago, down about 0.5%. We were down more than 1% kicking off the show at 3 p.m.
And just an honorable mention to add to that, keep an eye on oil prices, up about 4% for both WTI and Brent crude, apparently on the back of some of those headlines about the U.S. potentially increasing the sanctions on Russia. All right, as we kick you off to the close or get closer to those closing bells, let's bring in Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America. Savita, great to see you here. I want to start off with something that Sherry Paul started off the show talking about, and that was the broadening of the rally, the potential broadening of this rally that we've been in, specifically the AI-fueled rally. And you seem to think that there also could be a bit of a broadening outside of the tech space with regards to the AI trade.
Yeah, I think there could be a good broadening or a bad broadening. And a good broadening would be that other companies start seeing, better demand and inflection in economic activity. We were in this camp until very recently when we had kind of some negative risks reveal themselves. But the other way that the market can broaden is if we see stocks go lower, led by the mega cap tech companies that are some of the more, let's call it crowded, higher multiple companies in the S&P 500. So at this point, I think that our view has been constructive on equities, especially the average stock over the index. Mm-hmm. But now I'm starting to see some signs of risk in the overall index itself. So if you think about drivers of downturns in the equity market, they typically end with euphoric sentiment and real bullish themes driving the market, and we're seeing some of that today. So, for example, we have 10 indicators that we look at that signal, when to sell equities. Historically, what we found is that a few things tend to happen before a market peaks. They're sort of the necessary but not sufficient conditions. And at this point, 6 out of 10 of those indicators have been triggered. A typical bear market has seen an average of 7 indicators triggered, so we're just a hair below where we've seen kind of the stress point for equities.
So can you give me an example of one of those triggers, Savita, at least ones that's most important to you?
So the triggers are, they measure things like sentiment, kind of speculative fervor. And one of them is just looking at the performance between higher multiple and lower multiple stocks in the S&P 500. And what we've seen is that expensive stocks have outperformed cheap stocks for a while. We're also looking at things like credit stress or complacency. And when you look at our credit indicators, they suggest a very, very low volatility in credit, which suggests some level of complacency that typically is a precursor to market sell-offs. Other factors that make us worry are things like, when you look at just the overall level of margin debt normalized by market levels, it's at higher levels than normal. Then when you listen to earnings season, I think another warning sign is companies that are beating on earnings aren't necessarily outperforming the market as aggressively as they have in prior markets.
Yeah, absolutely. The bar is high. The beat rates are high, but so is the bar when it comes to investor reaction. I do want to talk a little bit about this note in your notes that you sent over to our producers, that it's a buyer's market for tech labor. This caught my eye because you think about the news that we heard out of Meta today, for example, cutting 600 jobs at their AI super intelligence labs. And I was hoping that you could expand on what exactly you mean by that and what does that mean for investors?
Well, I think that the idea of AI and consumer resilience continuing to drive the market is very hard to argue for, because part of what AI represents is downsizing, efficiency, labor lightness. And where you're seeing this is in white-collar professional services industries, which have, for the last 30 years been one of the biggest drivers of consumption growth in the U.S. economy. So I think it's hard to kind of square the circle where we think that AI is going to be a game changer and we're paying very high multiples for all of these AI stocks, and meanwhile continuing to believe the consumer will be resilient. Look, like any other technological revolution, I think that, this will create new jobs and remove old jobs. But I think right now we're in an environment where companies have kind of stalled out in terms of hiring. And part of that is because of the anticipation of efficiency gains. But, another layer of that is just macro uncertainty. So if you listen to industrials companies that have reported so far, they have highlighted kind of in concert a real lack of macro visibility. One of the reasons that we were more bullish and expecting a bullish broadening of the market in September was we were seeing a lot of these barometers that we track inflecting positively. We were seeing companies saying, we want to spend money. One Big Beautiful Bill Act is going to make us spend money sooner rather than later. So there was a lot of pent-up spending in the pipelines. Today, when you listen to these industrials companies after the hiccup that we saw in October with U.S.-China, now we have a government shutdown, no data for the data watchers to watch. So I think that now we're in an environment where industrials companies are citing this, macro fog. And they aren't necessarily expecting any of that spend in pent-up, kind of CapEx to materialize until 2026. So this is all sort of a deferred gratification story, which I think is worrisome when we're also seeing other hiccups in, other parts of the economy.
All right, Savita, always great to talk to you. Savita Subramanian, head of U.S. equity and quantitative strategy over at Bank of America. Stocks off the lows of the day, but red across the screen. We'll see if that changes in the next few minutes here, Katie, as we are expecting some big earnings out of some big names that could move the market, including from Tesla.
Absolutely. All eyes on Tesla here. The stock actually positive on a year-to-date basis, but we know that has come with some pretty stomach-churning volatility along the way.
Absolutely. We're also keeping our eyes on other names as well, including O'Reilly, Lam Research, QuantumScape, Las Vegas Sands, Knight Swift, and IBM. A full breakdown of all those earnings starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast that starts now. Carol Masser, Tim Stenovic, they join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A slew of big earnings, Carol Masser, coming after the bell tonight, including from IBM and Tesla.
Yeah, big earnings, right? And they're just going to get fast and furious over the next couple of weeks here. Having said that, we talked with Sam Stovall, and he reminded reminded us we're in the 64th quarter. It looks like out of the last 66 that earnings have surpassed estimates, but it's also revenue growth. Revenue growth is surpassing estimates. So is profit margin. So far, so good. But let's remind everybody, we got some big ones coming out.
Yeah, Carol also saying, and I think fairly during that we need to kind of maybe think about differently how we do estimates if we're exceeding estimates so frequently and
consistently.
Consistently. We're being managed pretty well.
Yeah, absolutely. I mean, that's sort of the game, right? The management talks to the sell-side analysts, and they sort of figure out where things are going to land. Though I will say, we were just talking with Savita Subramanian. She made the point that yes, beat rates are very high right now, 85%, but so too is the bar, that you're seeing a lot of post-earnings disappointment in shares.
Yeah, and I just wanted to, we talk about Tesla, and this kind of feeds into the AI trade. I know it's a car company. I know we're going to talk about EVs and the sales they get from that, but a lot of investors are looking ahead to this idea of an autonomous future, a robotics future, and that ties into the AI trade. And a lot of questions as to just whether Tesla is actually part of that or behind.
Yeah, well, we'll see. We'll get any updates, whether that somehow gets put into that earnings release remain.
Absolutely. Well, Tesla is slightly lower here on the day by about 0.9%. Right across the screen for all of the major indices and averages in the U.S., including the Dow Jones Industrial Average down 0.7%. The S&P 500, the benchmark, down 0.5%. The NASDAQ indices, the composite and the 100, each down by roughly about 1%. And your biggest laggards today, you're going to find that in the more cyclical and small cap space. Mid caps down 1.2%. The Russell 2000 small caps, Carol, down 1.5.
All right, back to the big caps I go. The S&P 500, guys, most names, no surprise, lower in today's session after we've seen the major indices under pressure. 302 to the downside, Katie 199, gaining ground to unchanged.
Well, let's take a look at the sectors, how they performed today. You did have 4 sectors manage to finish in the green, 7 in the red. You can see that the tech sector was down, and that's certainly taking a bite out of things. But in terms of what did do well, energy outperforming, up 1.3% as a sector. Consumer staples, healthcare, real estate also managing to finish in the green. But it's going to be hard to actually see the benchmark go green when you have tech weighing on things like that.
Yeah, right. Big pressure, lots of pressure. Having said that, Intuitive Surgical, definitely an outperformer, guys. Top in the S&P and NASDAQ. The robotic surgery company, you know them well, finishing the day just shy of a 14% gain. The company did boost its worldwide Da Vinci procedure growth forecast for the year.
Oh, so, I used one of those once.
I know.
Yeah.
We're so glad.
I mean, I didn't personally use it, but well, it was used on me.
Yeah, and I guess it went well.
It did. I'm still here.
We're so happy.
You know, the doctors
Thank you, Dr. Tawari. He's great, if you're watching.
The doctors wear goggles to use these. I was actually having a conversation with a surgeon last night who uses this machine, and he made the point that it actually hasn't changed much since he began using it over the last 10 years. It's remained relatively consistent with what it can do, and sort of, yes, it's gotten smaller a little bit, but it hasn't actually changed that much.
Sounds like a great dinner.
Yeah, we had burgers.
Okay.
Wow.
Well, all I'm going to say, great gainer, guys.
You go to dinner with me, you talk about stocks that are moving. That's what happens.
Cool.
All right, outperformance, but still the stock only up about, not even quite 1% for year to date here.
When he said burgers, did he mean like a veggie burger?
we did chicken.
Oh, okay.
We did
chicken.
Burger, yeah.
Oh, gosh.
Oh, my God. It always comes back to food when it's Tim. Always, always. Hey, Hilton, I just want to mention, Hilton Worldwide up about 3.2%. Also, a top gainer, I think, earlier in the session in the S&P. The company boosted its annual adjusted EBITDA forecast and the low end of its net unit growth outlook for the year. So some optimism there. And I was going to say Beyond Meat, but don't judge me. It was up 112% earlier in the session, guys, but actually finishing the day down 0.9%, but it's been on fire.
That was the range today?
Yes. It was down 27% at its lows today. So talk about.
That was like the widest. I was taking line. The widest range we've seen on that stock, at least since 2022, and on a percentage basis. I mean, what we've seen this week, basically the widest since it's been a public company.
But it's still up, right? Like, let me. Oh no, it's down.
It's down, Carol Masser,
for the year. I was going there.
All right, it's memeing.
Yeah. Now
All right, I'm going to talk about some non-meme stocks. Let's talk about Netflix, down 10% today. Biggest decline going back to April of 2022. This after we learned about a tax dispute with Brazil cutting into third quarter earnings and
I'm going to interrupt you here. Tesla
earnings
crossing the wire right now. Let's get right to it here. My apologies, Tim. Adjusted EPS in the most recent quarter for Tesla coming in at 50 cents a share. The street on average was looking for 54 cents. Revenue did come in above estimates, though, at $28.1 billion. So a beat on the revenue side, a slight miss on the EPS side. for cash flow, well above what the street was looking for, $3.99 billion in free cash flow. Now, the estimate based on Bloomberg reporting is 1.25. So that's almost 4 times what the street was expecting. We'll have to dive a little bit deeper into that. Gross margin, a slight beat at 18% here, and operating income coming in relatively in line with estimates, 1.62. Street was looking for 1.65.
Yeah, and you can see that the stock is kind of deciding what to do with this information. As you mentioned, of course, a big miss when it comes to adjusted EPS, but that free cash flow certainly is an eye-popping figure here when you take a look at it, being 46% higher year over year and more than double the estimate. Shares down just a little bit after hours. The volatility on this stock has been pretty incredible as well, up 100% since April's lows, but still only about 8% higher for the year.
Yeah, worth repeating that third quarter free cash flow number, $3.99 billion, massively exceeding estimates of $1.25 billion. Third quarter adjusted earnings per share of 50 cents. The estimate was 54 cents. Third quarter operating income, $1.62 billion. Estimates for $1.65 billion. Shares, though, still moving lower in the after hours, down about 1.5%.
Yeah, I mean, let's remind everybody. I mean, this stock has been on quite a tear. We've seen a bounce back off of its lows, and so some concerns when it comes to the valuations that we've seen compared with some of the other Mag 7. I mean, this is a company, Romain, with a forward PE of almost 251. So, investors want to see some outperformance or get an idea of revenue growth going forward.
Yeah, they talk. I'm just going through the investor statement here, and they talk a lot, not so much about the vehicles, but the idea of new products and looking to launch new products. Of course, they do flag some of the updates to the Model 3 and Model Y, but of course, a lot of talk about their other businesses, of course, in the hardware business, in the energy storage business, and of course, when it comes to robotics and automation.
And we are going to continue to keep an eye on Tesla. Let me just quickly break in and talk about Lam Research. These results coming out, adjusted EPS for the first quarter actually beating estimates here. Adjusted EPS coming in at $1.26. The estimate had been for $1.22. So a beat there on adjusted EPS. Also beating on revenue as well, coming in the first quarter, $5.32 billion. The estimate had been for $5.23 billion. You can see shares up about 1% in the after hours.
We'll get back to Tesla in just a moment. Meantime, Las Vegas Sands out with numbers. We're seeing the stock higher 4.7% in the after hours. Third quarter adjusted EPS came in above estimates at 78 cents. Third quarter net revenue coming in above estimates at $3.33 billion. Once again, shares in the after hours higher by about 4.7%.
All right, let's go back to Tesla, folks, because we continue to monitor this one, and it's been bouncing around here just a little bit lower, down about 0.6% here in the aftermarket. We're looking at Tesla posting third quarter profit that fell short of Wall Street expectations despite record EV sales, a sign of the pressure automakers are facing from shifting federal policies and rising costs. Adjusted earnings were 50 cents per share in the period, the company said. Analysts had expected 54 cents on average, and estimates compiled by us, revenue was $28.1 billion. But again, the stock, I agree that investors are trying to figure out this one, Romain.
They're trying to figure it out, and I think it gets to this idea of a company at an inflection point. When we talk about the EV side of the business, of course, the loss of that U.S. tax credit, a big issue here, not only for Tesla, but for its peers as well. They mentioned that in the shareholder letter, particularly when it comes to lower regulatory credit revenue and lower that hurt their overall revenue, but also impacted the bottom line with regards to profitability. They also mentioned a few one-time costs there as well that also did weigh on profitability too. So this is a company that, of course, looking backwards, you can see a lot of the issues that they're having to grapple with. But the big question, particularly when we get to that conference call in less than an hour's time, is what is the future? Is this going to be a discussion about new vehicles, or is this going to be more discussion about autonomy and robotics?
Well, they're going to try to make it about AI, autonomy, and robotics. I'm looking at the 29-page Q3 quarterly update. The third paragraph in talks about how every Tesla vehicle delivered today is designed for autonomy. Every Tesla energy storage product is capable of being enhanced and optimized by our virtual power planner auto bidder functionality. We continue to deliver a fleet of products that brings AI into the real world as we pursue a future of sustainable abundance as outlined in our master plan.
All right, IBM crossing the Bloomberg terminal. Here's the red sticky, the number that jumps out. Third quarter revenue, folks, slight beat, $16.33 billion versus an estimate of $16.1 billion. Software, so key. Third quarter software revenue of $7.21 billion. That is smack in line with what the street was expecting. Also, some of the outlook sees fiscal year free cash flow of $14 billion, had seen above $13.5 billion. The estimate on the street is $13.48 billion. Consulting revenue also important. Third quarter consulting revenue, $5.32 billion, and that too, Katie, is coming in better than expected. A quick check on the stock in the aftermarket, and I'm pulling it up on my Bloomberg, and it is down 3.5%, Katie.
Interesting. I mean, this was another name, though, where expectations were high. And you can see year-to-date through the close up 33% on IBM shares. So this goes back to what we were talking about. Beat rates are high. We're getting positive results here. But the reaction to some of these earnings reports certainly has been in the opposite direction.
And we should point out the CEO of IBM was at the White House yesterday talking about investing in the United States. So we'll continue to monitor that. All right, folks, that is a wrap. Lots more to come, I know, on both sides, TV, radio, and across the platforms here at Bloomberg. Katie and Romain continuing there on the close on TV. And, of course, Tim and I continuing here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And we continue to keep an eye on shares of Tesla oscillating between gains and losses after reporting results for its most recent quarter, a third quarter where adjusted EPS came in a little bit light at 50 cents a share. The street was looking for 54 cents. Revenue on the top line grew about 12% above analyst estimates at $28.1 billion. A slight widening in gross margin, a slight narrowing in gross margin, though gross margins did come in above analyst estimates. A free cash flow number, though, catching a lot of people by surprise, basically $4 billion if we round up. That's up 46% year over year, and it's well above street estimates for $1.25 billion. Ross Gerber joins us right now, co-founder, president, CEO of Gerber Kawasaki Wealth and Investment Management, and who used to hold a relatively large stake in Tesla. I'm not sure what your holding is right now, Ross, but I do want to get right to it here. When you try to even look at this company, value this company, what are you valuing it at? As an EV company or something maybe a little bit more lofty?
Well, we break it into two parts, really. And we do own still well over about $80 million worth of Tesla stock for our clients. And I personally still own the stock as well, just to start. But when you look at Tesla, you have your core business, the automotive, energy and such, and what that is worth and what we extrapolate out based off its earnings and its potential. That's probably worth about $150 a share currently. If you're looking at, let's say, $2 in earnings, and you're giving it a pretty big multiple there, 75, let's say. But then when you look at the rest of the stock price, it's 100% based off Elon or Hope on the new products, which is robotics and full self-driving. So, when you look at the cab business and the robot business, that's about $300 a share of value there. So it's really two parts, and a lot of it's built on what the potential is in the future versus what's the reality.
There's been a lot of questions about, as they sort of look to the future, the idea that they still need, obviously, whatever cash gets thrown off from the traditional EV business, if you will, here. Do you think there's enough of a bridge there, at least in terms of their focus?
Yes and no. I mean, it's predicated on some time frame for robotics to actually be profitable for Tesla, which is the cyber cab and the robots. And our position is it's going to take a long time for them to make money in these businesses, and that they really should be focused on their core EV business, which is wildly profitable, and they still make what I consider the best cars in the world. And so, the fact they're sort of poo-pooing the fact that they make the best car EVs in the world and really sort of letting that business sort of just falter, I think is a strategic error personally, because I think if they focus more on selling cars over the next year or two to bridge the transition and try to repair the image of the company in consumers' minds, I think that would be a lot better use of their time during this transition to the future that Elon sees.
Well, I want to talk about how connected those two things are, that they should focus on selling cars and they should focus on also sort of repairing the image that has been created of Tesla. A lot of that comes back to Elon Musk and the reputational damage that some have argued that he has inflicted on Tesla's brand value. When it comes to selling cars, though, they also have the fundamental issue, the fundamental headwind that EV tax credit has expired. Right. So talk us through the relationship between those two aims.
Well, you sort of had the best situation Tesla could have for this quarter in the expiration of the tax credit, and consumers in the United States came out and bought EVs a lot more so than in the rest of the world because of this expiration. But this is not good news because it's gone now. And so there's a lot less incentive to buy a Tesla this quarter and for future quarters indefinitely because the cost of a Tesla just went up by $7,500. Their response was to make a worse Tesla for $5,000 less. And I just don't think that's a great strategic move if you're trying to repair the brand. Now, a lot of people are talking about the cash flow, and the cash flow number is because they sold 50,000 cars out of inventory that were just sitting on lots, not out of production. And that's why cash flow is higher than expected this quarter, is because they were able to monetize inventory that just was sitting there. But that's also not per se good news, because essentially production is running at about 60 or 65% of capacity for Tesla right now because there just isn't demand for their vehicles. So they don't want to address demand. If they wanted to address demand, they would run advertisements instead of for Elon's $1 trillion absurdity. They would be running ads to sell cars. But they just seem to be in a level of advertising ignorance I've never seen in corporate history, that they just don't feel they need to advertise their products.
So you would say that the answer here, one of the answers is to advertise more, Ross. But talk to us about the overall EV landscape, though. It seems like this isn't just a Tesla problem. You're seeing this at more of the traditional automakers as well, that the demand for EVs just doesn't seem to be there, not in the way, certainly, that maybe some had expected. The traditional automakers can pivot here, of course. They can maybe lead into hybrids or just emphasize their gas-powered vehicles. Tesla, being a pure-play EV maker, doesn't have that luxury.
I mean, I disagree with your premise. EV sales were at a record high here in California this quarter. 25% of all vehicles. It's never been so high. In Europe and in Asia, we're seeing the same share, 20 to 25% of all vehicles. And that share has been growing. EV sales have been growing worldwide for quarter after quarter. It's the car companies and the oil companies that want to run the narrative that people don't want EVs. EVs are better cars. They're way better cars, and they save you $5,000 a year on gas. Consumers love the cars, and these companies that were making the cars weren't making money, and they can't wait to go back to the cash cow gas guzzlers that they used to sell us. This is not good for the world. It's not good for the environment, and it is unfortunately predicated by the loss of the credits. But the fact of the matter is people want EVs, and they're better vehicles.
I am curious, though, Ross. I mean, you say, okay, it saves $5,000 on gas, but at the same time, we've lost a $7,500 credit that made it even more attractive on top of that $5,000 savings. And I do wonder just about the value proposition. I mean, we're obviously privileged. I mean, we can go out and buy the cars that we want to buy, but a lot of people are cost conscious. And as somebody who a year ago was shopping for vehicles, it was a pretty stark difference in price between an ICE vehicle, or even a hybrid vehicle, and what I was seeing on the EV side.
Right, and that's not the case today when you look at the Kias and like the new GM. They just have a new GM EV. I think it's another Bolt or whatever. It's $30,000. You can buy a used Tesla on the market right now for $20,000. There's no reason why, if somebody has a lower income, they would want to spend money. It's like $150 to fill up your gas tank. Like, if you don't have money, why would you want to do that every week? Okay, it just doesn't make any sense, right? So I think consumers, would realize you don't have to pay for repairs, you don't have to pay for new brakes and all the stuff that oil changes. The cost of running an EV for 5 years is so substantially less than owning an ICE car. It's like, it's day and night. But, once again, they don't want the consumers to do this because it's bad for the car companies' profits. If everybody buys EVs, it's bad for GM. GM had a blowout quarter, and the reason being is they want people to buy gas cars. It's more profitable for them. But what's best for society is EVs.
I hear what you're saying, Ross. I will say that to some of your points, people would push back and say, what about the resale value? What about battery technology and how quickly it evolves? But Ross, I do want to get back to Tesla specifically, and specifically the shares, because you mentioned at the outset that you do still own Tesla. You used to own a lot more, but you do still hold it. And I wonder what you would need to see to give you the confidence to add to that position.
Well, we own it because we have clients like this guy, David, who is a really good close friend of mine, who's a wonderful Tesla supporter and has been forever and really believes in Elon's vision a lot more than I do. And, and I told David I was going to try to be more positive on these interviews because I don't buy a lot of what Elon's selling. But that said, if Tesla wants to see the stock meaningfully move higher, they need to produce results with full self-driving. It still doesn't work. Version 14 is still not level 4 or 5. I take Waymos and see Waymos every day. There's Waymos everywhere here in Santa Monica, and they work great, and they're just getting ahead every day of Tesla. So until full self-driving works, Tesla really can't go anywhere because all of autonomy is based around that. And we think that they have issues with a vision-only system that they're going to have to address at some point. So that's the real catalyst, that if I could get into my car right now when I leave work and push a button and it could drive me home safely, Tesla would just kill it. And that's what we're all waiting for, and that still hasn't been delivered 5 years in.
Yeah.
All right, Ross, always great to get some time with you. That is Ross Gerber. He is co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. And the earnings parade continues, Romain.
Southwest Airlines out with earnings. The shares higher in the after-hours trade. It looks like a modest beat when it comes to passenger revenue and a much better performance when it comes to EPS. Third quarter EPS coming in at 11 cents a share. The street was looking for a loss of 3.2 cents a share. That is the main headline here. The company also guiding slightly higher for the fourth quarter, saying that it sees 4Q capacity up 6% and 4Q unit revenues up 1 to 3%. And just real quickly, Katie, also Alcoa out with their earnings just a while ago. Those shares now moving to the downside by about 4%, a miss on a couple of key metrics here. We should point out they did post a loss per share in the most recent quarter of 2 cents. The street was looking for EPS of 14 cents. So a surprise loss per share there, pushing the shares down.
All right, we'll continue to follow that stories, but let's stick specifically with tech and Tesla. Erika Klauer, she is CIO at Science and Technology Partners. She joins us now. Erika, it's great to have you with us. Of course, we are surfing the wave of tech earnings that we got just in the past couple of minutes. Tesla front of mind here. When you take a look at that in combination with IBM and some of the other tech names that have come and report just in the past few minutes, what's your initial read?
So thanks so much for having me. I would say overall, the backdrop for technology earnings has been quite positive so far. Clearly, the earnings from Tesla were a little bit lighter than what people thought, but the sales were a little bit ahead. I think that if you look at Lam Research, for example, this evening, those numbers were quite strong, really confirming the backdrop for very strong infrastructure build for semiconductors on a global basis, Lam Research being one of the leaders in that field. So overall, we're seeing pretty good earnings so far.
Pretty good earnings so far. And I do wonder, what you make of the Tesla story at this juncture. We've been talking about sort of the different factors that have been driving Tesla's stock. You could value it as a car company. If you do, then that valuation looks pretty crazy. But if you think about the long-term vision that's being sold when it comes to Tesla as this robotics company, full self-driving, et cetera, maybe things get a little bit more reasonable. And I wonder which side of the ledger you fall on.
So at Science and Technology Partners, we tend to take a longer-term outlook, looking really out over the next 3 to 5 years. And while Tesla has certainly accomplished an extraordinary amount in terms of really creating the EV market on a global basis, I do think that market is a little more mature. And so what interests us is really looking at 2 aspects of Tesla's business. One is the energy business, and the other is the robotics business. And I think it's very interesting because Tesla has proven itself to be an extraordinary manufacturer. And so it can really leverage that expertise into production of robots. So that will be a key area to listen to when the company has their conference call later this evening, as well as progress on energy, which continues to, the demand there just continues unabated.
I am curious, though, when we talk, Erika, about this kind of the mashup of things. I mean, it seemed like for a while when it came to when we were talking about EVs, it was its own separate thing. Robotics was its own separate things. AI was its own separate things. Now you talk to some of these CEOs, and for that matter, a lot of the investors out there. There's so much overlap now in these spaces. What does that become, Erika? Where do you see that morphing into?
Boy, that's a big question. But I guess the taking a giant step back, what I would say is that we know now that AI is affecting literally every single industry. And there are some key bottlenecks that need to be addressed. I would say one of the ones that Tesla is uniquely positioned to help solve is that one of power. We are hearing that the grid is aged and it will take time to bring on more capacity. So having more portable power, standalone power next to data centers is a very important product, which is an area where Tesla exhibits leadership. So that's, I think, a very important piece of the overall progression of AI where Tesla can contribute significantly. And of course, the advent of AI is essential for the continued evolution of robotics too. So they're really all interconnected at this point and quite significant on the long term with regards to how much opportunity there is for these companies.
Where do you, I guess, want to see this go? I'm kind of asking you the same question, but in a different way. And I ask because when we talk to investors, and I ask them sort of, where is the big technology bet? Where is the big AI bet? All there. I mean, you get so many varied responses. And I guess that's a good thing, the idea that those responses have gotten broader. Because if you asked that question 2 years ago, it would have been, NVIDIA, Tesla, and maybe a couple other names here. Where do you think the money is going to go?
So I do think that there is money to be made on the power side. I still think it's going to take many years to build out the infrastructure on the power side. I think the power is there. It just needs to be harnessed. And there's a very significant investment cycle there. So I would be looking to power infrastructure plays. I still think there is a lot of work to be done on the compute side. So you mentioned some of the key players there. I also think there's a lot of work to be done on the networking side, both within the data center with leaders like Broadcom providing their chips to the actual networking equipment. And I also think it's worth looking at some of the optics areas because we are seeing more adoption of copper, I beg your pardon, of optics in favor of copper over time. So I think those are some key areas that ought to see very good growth. But one other area I would mention are the software companies that actually can use this technology, use this processing power to produce results. So I think that's a very important area to be looking at right now and perhaps a little bit overlooked at the moment.
And Erika, just quickly here, you mentioned power, and that's a topic that keeps coming up when it comes to Tesla, maybe an underappreciated part of their business. The company did say that its new solar and Powerwall lease will help drive incremental demand for its residential energy products. I mean, who is Tesla competing with here when it comes specifically to the power business?
Well, the advantage for Tesla is that many of those competitors are coming out of China. And with China having the home court advantage, I do think that they're uniquely positioned.
All right, Erika, great to get some time with you. Really appreciate it. That is Erika Klauer. She is CIO at Science and Technology Partners. And the breaking news continues, Romain.
Yeah, actually, before we get to that, I mean, there are a few things that we have to get to. There's a lot been going on. Jane Fraser being named chairman of Citigroup. Press release just coming out by Citi just a little while ago saying that she will actually take over as a chair as well. There's another big appointment out there also in the financial space.
Yeah, let's talk a little bit about Fannie Mae naming its COO, Peter Akwaboah, as the acting CEO. It's interesting. You take a look at shares. That's the closing prices, but after hours, not too much reaction here, but we know that there has been a lot of speculation around specifically these two names on the board.
Yeah, exactly. Sort of when they come out of conservatorship, so maybe a change there, a change over at Citi, at least internally here. We also want to go back to some of those earnings, particularly when it comes to IBM. It does look like we are seeing some cracks in the software space. IBM reported earnings, so too did SAP, which is a big European software maker. But IBM's seen basically what they call lukewarm growth that we saw in that Red Hat unit. And remember, that Red Hat unit had been kind of keeping things going here as IBM was making that transition to this sort of AI future here. We did see an increase in sales of 14%, but that was a slowdown from the previous quarter and a slowdown from what analysts had expected of 16%.
Yeah, and you can see the reaction in shares right now, down 5.5% on IBM. You compare where we were through the close, up 33% year to date. So clearly this was a story that was looking for more good news to keep that going. Didn't necessarily get it this round, but still ahead, I'm pleased to say. We'll keep the earnings conversation going on Tesla with former Tesla president John McNeil and former board member Steve Wesley standing by to dive deeper into that earnings report. Those conversations up next. This is The Close on Bloomberg. Well, let's dive a little bit deeper into Tesla's earnings report. Robotics, a big focus for investors as the company bets big on CEO Elon Musk being able to reshape the EV maker into an AI powerhouse. Joining us now is John McNeil. He is the CEO and co-founder of DVX Ventures and former president of Tesla. John, fantastic to have you with us on earnings day. So Tesla earnings missing here. They did have record third quarter deliveries, but when it comes to actually how the stock trades, it feels like it's in this transition period where, okay, the EV business, which is the bulk of Tesla's business at this point, starting to struggle. There's a lot of yellow flags there. And then you think about the long-term promise of the stock, the visions that it has with humanoid robots and things along those lines, not actually a material factor when it comes to Tesla's bottom line. And it just leaves the stock in this intense period of volatility.
Yeah, and I think it's not helped by the multiples. I mean, it trades for over 170 times next 12-month revenues and over 115 times next 12 months EBITDA, or I should say 170 times next 12 months earnings. So it's in the stratosphere when you consider it against other Mag 7 that are trading at 15 to 30 times. It makes those stocks look like a bargain in comparison.
So, I mean, when you think about some of the long-term ambitions here, and certainly the proposed pay package for Elon Musk hinges on him staying at the company and being able to deliver on those promises, but some of the visions and goals that they do have when it comes to robotics, when it comes to full self-driving, what do you think the timeline is there where it actually will materialize in a way that's meaningful?
I think full self-driving, we're probably going to see material impact emerging over the next couple of years, robotics maybe over the next 5 to 10. And so I think to be long at these multiples, you've really got to believe in that long term. But even then, it's a very pricey stock to own.
I am curious, John, just when we talk about this push into autonomous driving, and not just with what Tesla's ambitions are, but overall the industry. And it just seems like they're behind. I know they've talked a lot about it, but we've all been, I mean, if you've been out on the West Coast, you've probably been in a Waymo already. There was a headline earlier today about them doing more testing here on the East Coast, particularly when it comes to a Newark airport just in suburban New York and New Jersey. So, I mean, you have a company, at least with regards to Waymo, but a couple others that seem to be making pretty material progress in sort of realizing this future of autonomous driving on public streets. Is Tesla going to catch up?
It's a great question, and I think it's a challenge on two fronts. It's a challenge on the software and the hardware. So on the hardware side, Elon's pledge has been, if a car can drive with human eyes, so can the computer. But as Sterling Anderson at GM points out, humans also have the ability to hear and smell and touch. And we fuse sensors as humans, so we don't just rely on our eyes. And our eyes don't work very well in the dark and sun glare and in storms. So the rest of the industry, including Waymo, has made a hardware bet that you need LiDAR to make up for that. And you can certainly fuse the LiDAR sensors in. And so I think that's why you see other companies making more progress, is because the hardware choice is just superior, not only for being able to drive autonomously, but for safety. On the software side, all the other players are taking a hybrid approach where they're using both large language models and they're using rules engines around those. And that's important because at some point, if you get in an accident, a regulator is going to ask you, why did this happen? Show me where in the code where the cause was and how you fixed it. Tesla's making a different bet, and that is to use only an LLM end-to-end, which means they really can't tell a regulator what went wrong and where it went wrong, and if they could fix it. So I think that's why you see Tesla behind Waymo and behind, I think, some of the other manufacturers. GM reported today that they've got 500,000 users on their system, and they haven't had a single accident. And that cannot be said for Tesla.
I am curious also, what about the business model itself? I mean, we were diving here on Bloomberg into kind of just the economics of autonomous driving, particularly when it comes to the Waymo vehicles. I mean, this is still pretty pricey, and I know we're in the early stages of this. But is this a business model that you see can actually be competitive with current ride-sharing or cab-hailing business models?
Yeah, I think in Waymo's case, they've optimized for software and they have not really optimized their hardware costs yet. I think the advantage that car manufacturers have, take Tesla, take GM, is that they know how to manufacture and squeeze every penny possible out of a really great product, and still come to market with something that's elegant and beautiful. And so I think they've got a cost advantage in manufacturing these things at scale, no doubt. And so that may point to Waymo getting closer and closer to a manufacturer or two to help them bring those costs down.
And John, I want to talk a little about maybe underappreciated part of Tesla's business, and that is the energy division. I'm taking a look at our top live blog on the Bloomberg terminal, and it points out that there was a massive 44% jump in energy and storage revenue for Tesla. Of course, maybe coming off of smaller base than some would like, but still, you think about this coming at the same time that we're seeing the first surge in U.S. electric demand in decades. And I wonder, how much opportunity there is for Tesla when it comes to this division specifically.
I think that division has really been focused on residential and then grid power storage, and it's a rather small revenue source. So out of the $28 billion in quarterly revenue this quarter, it's around 2. So it's less than 10%. And if you compare that with GE Vernova, who is in that power space to AI data centers, they're doing tens of billions of dollars of revenue. So it's a very different application that Tesla's had in the past. And certainly batteries can play a key role, but the generation is the problem at power plants. You've got to find the power source. And so you've got to have something feeding those batteries, and that's the real challenge right now. And Tesla is not in that generation space today.
I mean, obviously you have a great perspective being an investor in this, obviously the former president. I am curious, though, too, about how you view some of the other car companies. We just heard from General Motors. We're going to hear from Ford, I believe, tomorrow after the bell as well. And I just was looking to, and I noticed, I don't want to front run it, but I know you've got a book that's coming out next year that kind of talks about the evolution of Tesla and SpaceX. But also in that title, you also throw General Motors into that mix as well. Not a name that I would think would be directly associated with the two others.
No, that's right. Like you can't imagine teaching a 100-year-old company that's a $200 billion revenue company how to get agile. But Mary Barra has. And it started with the EV Hummer, which they brought out in record time. And then they've continued to flow with more than a dozen new models, the latest of which is the Bolt, which is a $28,000 and change vehicle that's got 255-mile range. And what they're proving is that they can bring out really fantastic products in record time. And they've gone from 0 to number 2 behind Tesla just in a few years. They've built a company that's about 4 or 5 times the size of Rivian. So it's really exciting to watch them apply some of these principles of innovation that much younger companies have applied. And that's credit not only to Mary and Mark Royce, but the rest of that team. They've been very, very agile, and I think you're going to see them continue to be. And so they intend to be a force in this EV space, and they're proving it as now the number 2 share in the space.
All right, John, always appreciate catching up with you. Great insights. John McNeil, he's the CEO and co-founder of DVX Ventures and also the former president over at Tesla. Those shares down about 1.5% here in the after hours trade, Katie, as we await that conference call to start at the top of the hour.
Yeah, off their worst levels of the after-hours session, but still down here. We have a lot of earnings to get through, though, so let's take a check on some of the other notable movers right now. We start with SAP. This is an interesting one. Europe's most valuable software company. Its cloud revenue missed estimates. They blame the uncertain economy. You can see shares down about 3% after hours. Also want to point out Wyndham Hotels and Resorts. They basically cut their full year adjusted EPS forecast. Not something you want to see, down about 5% after hours, Romain.
Yeah, and it gets at this idea, too. I mean, there's going to be a lot of focus right now on consumer spending, and particularly when it comes to the ultimate discretionary stuff like travel. The airlines looks like they're holding up pretty well. I mean, we've heard from Southwest, which has had its own idiosyncratic problems. They just reported overall the numbers weren't bad. We heard from United and American, decent there as well. So we'll see whether the hotels can maybe keep pace.
Yeah, maybe they're just flying back and forth and not spending on hotels. But I do want to point out IBM as well. We've been following there. Maybe not a measure of consumer sentiment, but interesting nonetheless. And falling right now. They actually had pretty solid earnings, but lukewarm growth, as you pointed out, for their Red Hat software business. You can see shares down 5% right now. Pretty brutal reaction. And then O'Reilly Automotive actually cutting their full year cash from operating activities. The view there missing the estimate, but shares pretty much unchanged. This is the close on Bloomberg.
All right, we've been talking Tesla, a record quarter, believe it or not, in terms of EV sales, but the underlying numbers, both on the revenue side and the EPS side, causing some concern here about growth going forward, and particularly long-term growth, particularly when you go it against the backdrop of the unprecedented pay package for Elon Musk if he hits very key targets over the next few years. Joining us right now to talk a little bit more about what happened this quarter and what happens in the quarters ahead is Steve Wesley. He's the founder and managing partner over at the Wesley Group, which invests in several companies, including Tesla, where he was a board member for about 3 years leading up to the company's IPO back in the late aughts. Steve, great to have you here. Let's start off on the quarter that just was. I mean, no surprise here. We kind of know how many vehicles they're producing, how many vehicles they're selling. But we're now on this precipice where here in the U.S., that $7,500 tax credit that you got is no more. And I do wonder how that changes the value proposition for Tesla and whether that means that their goals, their short-term targets, can actually be met.
Well, that's the big question. I think the results are kind of a tale of two cities. What you're seeing here is record Q3 results, but what that really is an indicator that a lot of people are racing to get that tax credit that President Trump has taken away. So China growth looked pretty strong. U.S. growth, we saw the bubble, but we expected that. The worrying part was European growth. That was down 20%, but it's down 20% at precisely the same time EV sales in Europe were up 30%. So there appears to be some brand damage there, competition coming. Tesla's going to have to manage this. They've got to find a way to get growth back, profitability back up, operating margins down 40%. That's never a good sign. I think Q4 could be tough for them. They've got to find ways to get that revenue back up.
I am curious about sort of the methods that they would have. And maybe you can just kind of put on your hat from the old days. I know it was a long time ago when you were on the board, but there's this idea that you have a company that doesn't advertise in the traditional way and doesn't even necessarily market itself, I mean outside of advertising, in a way that you would see other car companies or really other consumer product companies overall. Could that maybe be a switch they can flip, or are they just so reticent to do that that it's just not going to happen?
Well, it's going to be tough to flip that switch, because you've got two things going on. There's Tesla, the auto company, and then there's Tesla, the technology company. And let's get down to the numbers. They did $28 billion in revenue this quarter. That's fantastic. But the last two quarters were $23 and $24 billion. They got to do $30 billion in Q4 to get back up to $100 billion. I think there's a good chance they end up at Q4 at a number closer to 25, 26 billion. That would mean this would be the first year in their history where they had declining margins. Now, when your PE ratio is 250 compared to NVIDIA, which is not exactly chopped liver at 50, you've got to wonder, will they be able to keep that up? Now, what do they do to fix this? One, come out with a lower cost car, not a $37,000 car. I think they need to announce they're going to bring a $25,000 to $30,000 car to market. Two, saving grace in the numbers this quarter, their energy division is taking off. They're selling more gigapacks in their new giga blocks than ever before. That grew 25% year over year. I think they're going to do $14 billion in energy products alone. So that's looking like the saving grace now. But I think within about a year, if they haven't really knocked it out of the park with their full self-driving or begun to bring humanoid Optimus robots to market in scale, they're going to have some explaining to do. You might see some grumpy investors.
I'm really interested in the energy storage component, and you bring that up. They obviously posted some big numbers there. And you think about who some of the winners of the AI boom have been, who some of the biggest winners are, and it's some of those companies that have been providing electricity to sort of power and meet all this surging demand. I mean, how much would you expect Tesla, the current makeup of Tesla leadership, to actually talk that up, especially on the earnings call, which we're awaiting in the next coming hours? Looks like we might have lost Steve.
Oh, wow.
It's unfortunate. I did see
just lost Steve just a little bit there.
It was a little bit chilling.
Yeah.
Hopefully we can get him back, because I do think that's a really important question here when you just think about the stock and the investors holding it.
Yeah, absolutely, too. And, it's kind of, we didn't get a chance to ask him, but I really did want to kind of go over some of these targets, of course, that Tesla had laid out for Elon Musk with regards to that pay package, because it gets to this idea of the evolution of this company and, the idea that we won't necessarily be talking about it as a car company, right? It was 20 million vehicles delivered overall, but it was also 1 million robots delivered, 1 million robo-taxis in commercial operation, and then, of course, a lot of EBITDA targets, as well as subscriptions to its full self-driving mode, which I don't think actually really truly exists yet.
Right.
So these are really lofty things. When did they get there?
Yeah, and I'm glad you bring up some of the specific targets, too, beyond the market cap that Tesla needs to reach, $8.5 trillion over the next 10 years. For those keeping track at home, NVIDIA currently valued at about $4.4 trillion, so you have to nearly double that. And at least right now, where we stand this juncture in Tesla shares, it does seem like that is going to be very hard to do. But we've seen ambitious pay packages for Elon Musk before with ambitious targets, and he's met them. Yeah, absolutely. Now, we should point out, of course, we've seen the shareholder letter, the statements, the fundamentals that they put out here, relatively staid in terms of how they laid it out. A lot of questions, though, about that future, and they do have a conference call starting in about 10 minutes' time. We're going to catch up with Ed Ludlow when we come back after the break here on what he expects to hear off that call. Stick with us. This is Bloomberg. We are counting down to Tesla's earnings call, where investors will be waiting to hear updates on how EV policy changes will hit Tesla's future deliveries and how their AV plans are progressing as well. Here for more is Bloomberg Tech co-host Ed Ludlow. So certainly there's going to be a lot to talk about on this conference call. What do you think, of course, is top of mind, and what actually Tesla executives will talk about?
Yeah, I think top of mind is how Elon Musk and the others will explain those operational goals that Remain was running through, right? We know that the quarter gone, strong deliveries because of the pressure of an expiring federal tax credit. But if you just do the simple math of the board requiring Tesla and Elon Musk to deliver 20 million EVs over a 10-year period, you have to average 500,000 vehicles a quarter anyway. And so if you accept that the prior quarter was a bit of an anomaly because people rushed to get ahead of the federal tax credit expiry, how will they maintain volumes going forward in a world where robotaxi and humanoid robots are the priority? And in the shareholder deck, at least, all that they explain is they now have a broader product mix and they want to do better with the factories they have around the world for volumes. But it doesn't answer the question that you guys were going through with Steve Wesley, which is that 40,000 EV that we got from Tesla announced this month isn't the $25,000 one people were calling for.
I mean, well, why not, Ed? And I mean, maybe that's a question you can't answer, but I mean, we've seen other EVs on the market in the U.S. that are below that price point, some basically around 30 grand, give or take, and that's not even taking into account the tax credit.
Yeah, I mean, the reporting from Bloomberg has been really consistent. They were never going to do a standalone $25,000 EV that was a standalone model. The idea was always to engineer and reduce component count out of the Model Y and Model 3, and that's exactly what we got. The assessment is that they didn't do enough. You know, I posted in the Top Live blog, but if you leased a Model Y in 2024, even the balance of this year, you could get it for $300 a month, there or thereabouts, with many of the core premium features. This new variant of the Model Y, for example, doesn't even have a glass roof, and that's left lots of people from Wall Street through to everyday consumers asking, well, what was the point in all of that? Right. And actually, to this point, Tesla's not really explained it, so maybe they will on the call.
Well, I also want to talk about the global landscape here, because also in our Top Live blog, which is fantastic, by the way, Shelley Banjo points out that you take a look at some of the charts that they put out in their earnings release. They have a chart of market share globally, and it really shows how much Tesla has fallen behind when it comes to Europe, when it comes to China. Those are two very different markets. Europe, maybe they can get back there, but China, is that a lost cause when you think about some of the homegrown competitors in China?
In China, the focus for Tesla, and it's spelled out in the deck, is that they want to take FSD supervised, the software they charge for, to that market. And they talk about how in New Zealand and Australia, where they've just launched, that is the precursor to offering the software in China, which, as you say, is a critical market. The story for Tesla in China historically was shiny American brand, premium product. It's really cool to have one, until politically it was difficult for a Chinese citizen to go with a Tesla rather than a domestic player like you've just discussed.
Yeah.
The hope is that software is what will be the differentiator for them, but it's pending approval by regulators in that market.
All right, Ed, we got to leave it there. Ed Ludlow, the co-host of Bloomberg Tech. And just a reminder, that conference call with Tesla kicks off in about 4 minutes' time. Meanwhile, let's push ahead to what the markets will have their eyes on over the next 24 hours. And it includes a whole slew of earnings. We'll start before market, Katie. We have Blackstone, T-Mobile, and we were just talking about Southwest American Airlines reports tomorrow.
Yeah, looking forward to Blackstone earnings, in particular with all these credit concerns in the economy. But after market, we also have Ford, Intel, Deckers, Baker Hughes as well. So certainly a lot to dig into when it comes to corporate America.
Yeah, Intel could be big. Of course, we all know they're dealing with a lot of idiosyncratic issues, but I think also a lot of people want to know about that push into AI infrastructure, whether the spending is still there and whether Intel is actually involved. Meanwhile, the after-hours trade here, Tesla shares still under pressure here in the after-hours trade. Some of the more interesting movers, though, I mean, speaking of chips, Lam Research up about 2% here. Modest results here just after.
Yeah, there you have it. At the same time, IBM down about 4%, but that does it for us. This is the close.